වාණිජ, විද්‍යා, ගණිත, කලා, තාක්ෂණ වේදය, විෂය ධාරාවන් වල සියලුම විෂයන් සඳහා විශ්වවිද්‍යාල කතිකාචාර්යවරුන් සහ රජයේ පාසල්වල ප්‍රවීණ ආචාර්ය මණ්ඩලය විසින් මෙහෙයවනු ලබන දේශන නැනපවුර YouTube channel ඔස්සේ නැරඹිය හැක. ඉදිරි දේශන දැනගැනීම සඳහා නැනපවුර YouTube channel subscribe කරන්න. දැයි දූ දරුවන්ගේ අනාගත ජයග්‍රහණයට.
Hello everyone, now we are going to start today's business studies lecture. So I warmly invite our Madam Sanjeevani for today's lecture. Hello Madam.
Hello, good evening. All right, so today we are hoping to start insurance. I'll share the screen. Okay, children, so insurance is the next unit that we are going to start. So after this, transportation, communication that we are going to do in detail. So that will be the next class. So in this class today, I'm going to cover insurance. Right, so now we'll see what insurance is. Right, you must have heard about this term, no? Right, so in day-to-day life we are discussing about insurance. Some insurance agents come to our places and they force us to get the insurance coverage from their institute. So likewise now we, like, you know, when you put the vehicle to the road, right, if there something happens, so you just cover that damage from insurance. So that insurance is a common term that we use in day-to-day life. So you need to know what insurance is, children. So what is it actually? It's like, you know, it's kind of a pool of risk, like, you know, it's a kind of a contribution that the business now that was originated in Italy, right, in Italy. So they, like, you know, the people who have owned ships, they like thought that they need to contribute and they need to have a common, you know, fund, right, if something happens, so that from the fund itself that they will settle the damage. Right, that was the original, I mean, insurance originated from that time itself. Right, so then, you know, like there is a common term that we discuss under insurance. It's the risk. Right, we'll see what risk is. What is risk? The space of occurring damage which can be estimated financially. So if you, now there are certain risks All right, children, we'll start from the beginning because of the power failure. Right, so we'll start insurance from the beginning. So there was a disconnection because of the power failure. Right, so insurance, so I told you that was originated in Italy. So then the main topic that we discussed under insurance is the risk, right? So what is risk? That's the space of occurring damage which can be estimated financially. So that's risk. Then I gave the definition for insurance. So how do you define insurance, children? It's kind of an agreement, no? Right? So agreement between whom? Between an insurer and the insured. Okay, so insurer and insured. So that is the agreement between those two. Okay, so based on what? To pay the premium. To pay the premium, and the insurer agrees to pay compensation, right? That the insured face from insured risk, right? So that's the insurance definition, right? So what's basically insurance? It's kind of an agreement between an insurer and the insured, based on what? To pay, insured agrees to pay the premium and the insurer agrees to pay compensation for the damages. Okay, so this is basically insurance. Then we'll see there are two types of risks. Now I told you know the definition of risk. So there are two types. I told you there are certain risks that you can estimate it financially, but there are certain risks that you cannot estimate, right? So likewise, there are two types of risks: insurable risks and non-insurable risks. All right. So now we'll see what the characteristics that are there in insurable risk. How do you know that these risks are insurable? These characteristics should be there. What? You can forecast. So if it's an insurable risk, you can forecast. You know definitely now this might happen. Okay, then risk that may happen in future, and you can calculate in terms of money, right? You can estimate that basically, right? The damage can be like 50,000, right, or 500,000. That risk that will happen in future can be calculated in terms of money, and the risk should not be certain, right? Also, in other words, the loss should happen in a random way. Okay, sometimes uh, 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 in a different manner that your car might get an accident, face an accident. So in a different way, in next month again your car might get face an accident. Okay, so that there will be different. Then it should be of no connection. You can't say that there is a connection, right? So what do you mean by that? The loss that happened should be not related to any other insured loss. Okay, there should be no connection, and it should be verifiable, right? So that means the cause for the loss, the place where it occurred, and the time, right, and the amount that can be analyzed. So these are the characteristics that should be there in insurable risks, right? I hope that it is clear. I told you the definition for risk, and I told you there are two types of risks: insurable risks and non-insurable risks. So these are the characteristics of insurable risks. All right, then okay, wait, I'll maximize this, then you can see properly. Okay, so I hope that it is much clearer now than that. Right, so now these are the characteristics that should be in insurable risks, right? Then what are the examples for insurable risks? Now you know the characteristics. Once again, I'll tell you the characteristics. Risk can be forecasted. Then risk that may happen in future can be calculated in money, in terms of money. Then it is not certain, right? So the loss should happen in a random manner. Then it should be of no connection. There is no connection as well. Okay, and it should be verifiable. Okay, you can exactly tell the place where that happened and the time, the amount, verifiable. So these are the characteristics in insurable risks. Then what are the examples? The risk that may caused by building catching fire, right? So building catching fire can be insurable risk. So if when you just have a risk like that, so you can just verify, you can just check whether all these characteristics are there in this. And the risks of motor vehicle accidents, also insurable risk. Damages that happen to money in transit, when you're sending money, when you're receiving money, right? In the meanwhile that something happened, okay, so that is also insurable risk. The risk of not receiving the money from a debtor, that is also insurable risk, right? So these are some of the insurable risks. Now we'll see. Now I told you, two types of risk, insurable and non-insurable. So what are the characteristics of non-insurable risk? Now the opposite of those characteristics of insurable risk can be taken as characteristics of non-insurable risk, right? Now risk cannot be forecasted, right? So insurable risk you can forecast, but here you cannot be forecast. Then risk that may happen in future cannot be calculated in terms of money. Then risks should be certain. You know that will happen definitely. So it is certain. So those risks you cannot insure, right? Non-insurable risk. Then there should be a connection, and it should not be verifiable. You can't exactly say, tell the amount and the time, right? So you cannot verifiable. And these are the characteristics of non-insurable risk. All right. Now we'll see the examples for non-insurable risks, children. Business experiencing loss. Now this year you might get a profit. Next year you might get a loss, right? But you can't insure loss, no, right? So this is one of the examples for non-insurable risk. Then risk for natural disasters, right? Depreciations, natural reasons, okay? Depreciations, expirations, right? Vaporizations. So those are natural things. So that those are non-insurable risks. Then risks decided by one's ability or the strength, right? Failing of exams, loss in love, right? Those things also cannot considered as insurable. The risk caused by the change in design. Now me as a customer, right? I myself as a customer, right? I can change my taste now next month, right? I might be using a different style this year or this month. So next month I might change my style of dressing. Okay, so the risk caused by changes in design. Okay, that is also non-insurable risk. So these are the examples for non-insurable risk. Then we'll see the importance of insurance for the business. Now, why do you think insurance is important for the business, children? Why? Investors, now it says investors, they are motivated to start businesses since the risks of the businesses are covered by the insurance. Now, suppose that you are investors, right? So you want to invest money in the business, right? But there is a risk to children. Okay, so now even though like when you're investing, there is a risk. Sometimes you might get a good return, sometimes you might not, right? There is a risk. But even though if that the business is covered by an insurance, he has some hope, right? So they will be motivated then, right? So that is a plus point. Okay, so investors, they like if the business is under insurance, right? Then they, and the other thing, receiving protection in terms of money when disable or death, right? Now if from employee side, if something has happened, right, so they will get the money, like they will get certain coverages. Okay, so that will just give an idea like the protection. Then capital for the development of the country is also provided because of the insurance companies, right? So they also contributing to the economic development. Then the international trade also can be enhanced, children. So because of marine insurance, right? So that can be developed. International business also can be developed. So these are the importance of insurance for the business. All right. So then we'll see the agreement, insurance agreement. So what is this agreement? I told you insurance is an agreement between insured and insurer, right? So this agreement, it is a written agreement, children. Okay, it's a written agreement taking place where? When an insurance proposal for right? And presented by the person who intends to obtain an insurance coverage, right? So that will be accepted by an insurance institution, right? Suppose that I'm going to get an insurance, so I'm coming to you as the insurance institution, right? So I'm getting the insurance coverage from your institute. So we both of us come to an agreement, right? It has to be a written agreement, okay? So that you also will promise me to give the certain benefits, and I also promise you to pay properly the monthly the amount, okay? So that's the insurance agreement. So what is insurance agreement? Once again, it is a written agreement that takes place when insurance proposal form presented by the person who intends to obtain an insurance coverage is accepted by an insurance institution. So actually the written agreement should be there. Then what is policy, children? So now two terms, don't mix those two terms. Insurance agreement is a written thing, right? So written agreement, okay? Insurance policy, what is insurance policy? It's a written certificate. Now when you get the insurance coverage from the institution, they will give the certificate thing, right? The written certificate is known as insurance policy. Okay, so this is given by an insurance institute for the insured after an insurance agreement for a life or a property has taken place. So when you get the coverage for a life or the property, then only you get this written certificate. So this is known as insurance policy. All right, so I hope that it is clear. Insurance policy and insurance agreement. Then the most important thing in this insurance, there are related, the parties, in the insurance. Now from the beginning also I told, now I just mentioned, when I'm describing, I mentioned insured, insurer. So you might be thinking what? Now these are the related parties in the insurance agreement. Who is the first party? Insured, right? So who is this insured? He is the insured is the person who presents an insurance proposal, right? So if I'm the first party, I'm the one who's proposing, right? I'm presenting the insurance proposal, okay? Then second party, which is the second party, is insurer, right? Who is the insurer? The party who accepts the insurance proposal, right? So I'm giving my proposal, so you are accepting, so you are the insurer, right? So basically it's the insurance company or institute, right? Then who are the third parties? All the external party that comes under third party, okay? Right, so there are main three parties: first party, second party, third party. Who is the first party? Insured. Second party, insurer. Then the third party, right? Now the validate an insurance agreement. Now when you want to validate, there should be following things, right? So what are the things should be there? Idea should be there. So to get the coverage, you should get an idea, idea of legal obligation, right? Then offer or a proposal, then you should accept that. Then legal validity should be there, and ability to have legal obligation by parties. Okay, so to validate an insurance agreement, there should be following things. What are the things should be there? Idea of legal obligation, insurance offer or proposal, acceptance, legal validity, then ability to have legal obligation by parties, right? Then the next one is principles of insurance. Now here for your A-levels, now your ultimate target is to face A-levels or advanced level properly, So here, now principles, of course, now for your advanced level, they don't just ask what is insurable interest, what is utmost good faith, what is indemnity, no, right? They don't ask those, the small questions in that manner, right? So you need to know in detail about these principles. Then they will give a case study. Then you need to identify what principle that they describe here. Understood? That's the way that they will give you. So now we'll see there are 6 principles that we are discussing here in this lesson, right? So first one is insurable interest. Second one, utmost good faith. Third one, indemnity. Fourth one, subrogation. Fifth one, contribution. Sixth one, proximate cause. Right? So now we'll see the principles. The first principle, insurable interest. It is like this, children. Insurable interest is, now by having a property, if you get an economic advantage, right, or by not having that property, if you don't get an economic advantage, or if you get a disadvantage, economic disadvantage, then we can say that you have an insurable interest. Now suppose that you have a house, right? So by having that you will get an economic advantage. No? By losing that also you will get economic disadvantage. That because it's you, it's yours, your house, sorry, it's your house, right? So then that means you have an insurable interest over that property, right? You don't have the interest over your next door, like, you know, your neighbor's house, no? Right? By having your neighbors, now your neighbor is having a house. So by having that house, you will not get economic advantage, or losing that you will not get economic disadvantage, right? Why? Because you have no right, right? You don't have that insurable interest over your neighbor's house. But you, in your house, you have that economic advantage. So this is known as insurable interest. All right. So now here I have defined the interest over anything whereby the existence of it causes economic advantages and the loss of it causes economic disadvantages is known as insurable interest. Right. So now some examples that I have given in this. Okay. So now there are insurable interest over husband's life to wife as well as over wife's life to husband. Right? And the legal owner of any property has insurable interest over the property, right? So, and the creditor has insurable interest over the debtor's life. Okay, so these are some of the examples for insurable interest. So I hope that you will get a proper idea about insurable interest, right? So if you get, by having something, if you get an economic advantage, or by losing that, if you get economic disadvantage, so this is known as insurable interest. So you need to know some examples as well. Then second principle, utmost good faith. Now first principle we have discussed. Second one is utmost good faith. What do you mean by utmost good faith? Now, you as the person now obtaining the insurance coverage, you need to disclose everything that you have, like, so whether you have a bad health habits, right? So the eating habits, or all these things you need to disclose properly. And from the insurance institute side also, that they should tell everything about the policy that you are going to obtain. You will get this, you will not get that, and something like that. They need to tell everything. So revealing all the information, right, from both the parties, that is known as utmost good faith. Okay, so revealing all the information related to insurance agreement by the insurer and the insured morally regarding the object, then subjected to insurance, is known as utmost good faith. So now you know two principles, insurable interest and utmost good faith. Then third one is indemnity. What is indemnity? Now, when an insured property has been damaged, the payment will be, sufficient to recover the damage. Right? Suppose that the damage was 500,000, right? Now, the value of the vehicle or the car is 40. We'll see more than that, right? We'll see the motor vehicle is 2 million, but the damage is 50,000. Okay, so but you will not get 4 million, right? Only to cover the damage you will get the amount, that means 50. Right, so if the damage is 50,000, cost 50,000, you will get that 50,000 to recover the damage. You will not get the market value of the vehicle, right? That is indemnity, right? From the insurance, you can't gain a profit over it, right? Only to recover the damage, only you will be getting the amount. All right, so that's known as indemnity. So when an insured property has been damaged, payment of an adequate amount of the compensation to restore the property, right? That's known as indemnity. Now, fourth one, contribution. So now I will take an example and let you know. Contribution. Contribution is like, where now I have a property or the vehicle. I have insured that in insurance company A, company B, company C, respectively. Right? So if something has happened, if the damage occurs, then how, well, if the damage is, we'll see 15,000, right? The damage is 15,000. So how will I get the damage? How will I get the compensation? So 15,000 separately from A or 15,000 separately from B and C? No. They will contribute and they will give me the 15,000. That's how they do. All these three institutes, insurance companies, they get together and they contribute and give me the compensation. This is known as contribution. So when a property has been insured in several insurance companies, and if a damage has occurred to it, payment of compensation by all the insurance companies for it by contributing proportionately is known as contribution. Right? So I have given an example here. If a property worth 10 lakhs has been insured in 3 insurance companies, so as A, B, and C, so 5:3:2 respectively. And if the damage is 100,000, so how will they give the compensation contribution? 5:3:2. No? So then A will get 50,000, A will give 50,000, B contributes 30,000, and C contributes 20,000. So you need to find the amount in that ratio. Okay, so that is contribution. All right. So altogether we have discussed insurable interest, utmost good faith, and indemnity and contribution. The next one is subrogation. Right? What is subrogation? Now suppose you have a ship, right? So that got sunk in the sea. Then insurance, now that you have insured that ship, no, so the insurance company paid you the full amount because you lost the ship also, now the whole thing, no, right? Then they have paid the full amount. So after that, they found, after certain time, they found a part of a ship. But the insurance company, now you will not get a right to get that part. Because why? Because you got the whole compensation, the whole amount. So you have transferred the authority to the insurance company now. So you can't claim anything now, right? You have no right to get that. So everything belongs to insurance company now. Okay, right. So that is subrogation. When the insurance company has settled the loss for the damage, then insured property then can transfer the other advantages and rights for external parties, right? So to the insurance company. So this is known as subrogation. Right now, here the example that I have given, if a motor vehicle insured for 50 lakhs is destroyed totally in an accident, then the insurance company pays all 50 lakhs. So as compensation. Then takes over the debris of the vehicle. So you have no remaining now. Okay, so that's subrogation, right? After getting the full compensation, you can't claim again, right? You can ask for anything that they have found out later. You can't ask anything now because you got everything and that's clear now. So that's subrogation. Next one is proximate cause. What is proximate cause? What is proximate cause or proximate reason? So now there are several reasons for the cause, damage, right? So they will pay you for the closest reason, which covers the risk. Right now, suppose that your house, you have insured for fire, theft, right? But not for flood. But if something has happened from flood, you will not get the compensation because you have not insured your house under flood, right? Because under proximate reason. Okay, so now when several reasons cause the damage of an insured property or a life, the payment of compensation is made only if the proximate reason is covered, right? Now the example I have given, a person owning a theft insurance policy cannot obtain compensation if his home is damaged by a fire. So the reason is the risk of catching fire hasn't been covered by the insurance policy, right? Like as the example that I have given, right? This is known as proximate reason. Okay. Now we'll see again principles of insurance. Now 6 principles I taught you today. Insurable interest, utmost good faith, indemnity, subrogation, contribution, proximate cause. Then we'll see there are principles relevant to life insurance and there are principles not relevant to life insurance. Now, we'll see what the principles that come under life insurance. Insurable interest will come under life insurance. Utmost good faith will come. Proximate reason will come. Those 3 principles will come under life insurance. But the principles that will not come under life insurance, indemnity, contribution, subrogation. So remember, these things also they ask. Then what is reinsurance, children? So there are certain terms that we discuss here. What is reinsurance? Insuring back a risk that is undertaken by an insurance company by itself under another insurance company, or many are known as reinsurance. Right? So insuring in several insurance companies can be known as reinsurance. Right? So you are insuring in another insurance company. It's like that. This is between insurance companies, children, not between you and an insurance company. Right? Now you are insuring your ship in one of the insurance companies. So what they will do, because it's a heavy, asset, so they can't, bear the risk alone. What they do is the insurance company is insuring another insurance company, right? That is reinsurance. That happens between 2 insurance companies, right? One particular insurance company is insuring in another insurance company is known as reinsurance. Then what is underwriting? Underwriting is dividing the risk of a property which has a higher value, right, into several companies and handing over the risk to several insurance companies. So that's underwriting. If it's a heavy asset, you divide and you just insure in several insurance companies. Okay, that's underwriting. Then we'll see what life insurance. Now I just gave an idea about life insurance. No? Life insurance or long-term insurance. What is it? Now, when faced with risk due to the demise or physical hazards of the insured, providing monetary benefit to the insured or his beneficiaries is done in life insurance. Right? So what's the aim of this life insurance? It's to protect a certain person against the loss caused as a result of demise or disability or turning to old age, right? So that's life insurance. Now, life insurance is obtained for a certain period of time, children, right? If the insured dies during that period, the agreed total value is given to beneficiaries or named person. Right? If he lives until the period is over, he can obtain the value of the insurance policy and the benefits as well, bonus also. Right? That's the nature of life insurance. Then we'll see what's the differences between life insurance and ordinary insurance, other insurance, general insurance. Now, life insurance, the risk is certain. You know definitely that we will die. No? Okay, so life is certain, the risk is certain. But other insurance, the risk is uncertain. You don't know. Today you will face an accident, but tomorrow no. Right? You never know. Okay? The risk is uncertain. So under life insurance, the second one you can say, indemnity principle is not relevant. Right? So indemnity is you can't get a profit over it. So that principle doesn't come to life insurance. But whereas other insurance or general insurance, you get that policy or the principle. Then life insurance is equal or equivalent to a saving in life insurance. Why is it? So life insurance is equivalent to a saving in the sense, right? If you don't die, right, you will get the money back, no? Right? So it's kind of a saving, right? All the beneficiaries even get. Then other insurance, it's not a saving. If something happens, only that you will get that money. Otherwise, no. Okay. Then life insurance policy cannot be transferred. You can't transfer your life insurance policy to somebody else, no? But other insurance you can transfer, right? Now your vehicle, if you are selling, you can sell the insurance policy as well, right? So these are the differences between life insurance and other insurance. Okay. Then we'll see the general insurance. General insurance, these things come under general insurance. Fire insurance, theft and burglary insurance, natural disaster insurance, sorry, marine insurance, motor vehicle insurance, liability insurance, goods in transit, money in transit. These are the insurance that we discuss under general insurance. Okay, right? Now, one by one, we'll see. Fire insurance. Now, you must have heard about fire insurance, right? Insurance that can be obtained to cover the losses caused to a person, building, or any other property due to fire is fire insurance, right? If something has happened due to fire, that comes under fire insurance. It's easy. Then what's up? I'll show here. Apart from the losses caused due to fire, now these following risks can also be covered in the policy. What are the other things that can be covered? Losses by riots or strikes, losses by explosions, losses by electricity, earthquakes or tsunami, flood, aircraft crashes, losses from crashes, consequential losses. So apart from fire, these things also will be added. Okay. Then next one is theft and burglary insurance. What do you mean by that? Theft insurance policy can be obtained to cover the risk that can happen to business premises or to homes from thievery, right? So that is theft. Natural disaster. So that can be obtained to cover the losses occurred to properties such as by storms, right, floods. So natural disasters. Then marine insurance. What is marine insurance? The losses caused to ships and goods in them while transporting by the sea can be covered by marine insurance. There are two parts of this insurance. What are two parts? Hull and cargo. So what is hull insurance? Right? Hull is the body part of the ship. Cargo is the goods that or the things that you transport. So these two are the main parties in marine insurance. Then different kinds of insurance policies under hull insurance. So what comes under hull insurance? Full option, total loss, port risk, maintenance, construction, all risk insurance policy. These things come under different kinds of insurance policy. Then different kinds of insurance policies that come under cargo. Cargo insurance, what comes? Valued policy, open cover policy, future time policy, right? This has to be changed, future time policy. Then the next insurance is motor traffic insurance. What do you mean by motor traffic? It is an agreement made between an owner of a motor vehicle and an insurance company, right, to obtain compensation for the losses occurred to motor vehicles, right? When traveling in motor vehicle, when people traveling in motor vehicle and other external parties, right, due to motor vehicle accidents. So there are kinds of insurance policies that come under motor vehicle. So sorry, motor traffic insurance, full insurance, third party fire and theft insurance, and third party insurance. Sorry, right? Full insurance, third party fire and theft insurance, third party insurance. So what is full insurance? That also I explained you earlier, right? So by a full insurance policy, losses to the relevant vehicle, people, property, right? Everything will be covered. So from full insurance, okay? Then third party fire and theft insurance. Third party fire and theft insurance. Now, then apart from losses to relevant vehicle by fire and theft, losses to external people and properties are covered, right? So full insurance cover everything, all the parties. So second one is third party fire and theft insurance. No, that will cover the relevant vehicle by fire and theft and losses to external parties also, right? That is third party fire and theft. Then the next one, minimum third party. So minimum third party, only the properties that are covered, right? So if to run a motor vehicle on the road, at least you need to have a minimum third party insurance. Otherwise, you can't you can't put the vehicle to the road, right? So that is only to a third party and property. All right. Then next insurance policy is the liability insurance, right? So what is this liability insurance? Ensuring the liability for the losses caused to other parties is known as liability insurance. Now, because of your business, if something's going to happen to the customers, right, for other parties, that comes under liability insurance, right? So because of this insurance, businessmen can get protection, right? So if you're a businessman, if you have got the liability insurance coverage, so if someone has filed a case, even you can get the compensation from your insurance company because you have got the liability insurance coverage, right? So now under that, now these are some of the liability insurance policies. One, general liability insurance, product liability insurance, employer liability insurance. Okay, those are the three liability insurance that we discuss under general liability policies. General liability insurance, what is it? Insurance coverage obtained by relevant businessmen or owners of the properties for the loss that may unexpectedly occurs from properties or from business activities, right? So that means if something has happened because of your property to another external parties, so that if you will be covered from this insurance, right? So if it's a product liability insurance, so what is product liability insurance? If you are a businessman who, like produce soft drinks, just take an example, soft drinks. So because of your production, if something has happened to consumer, and if they have filed a case against you, so you will be protected because of product liability insurance, right? So this is actually a coverage obtained by a businessman for the losses that may occur to consumers by consuming the product that you produce, right, or sells. So now under liability insurance, there are three: general, product, then employer liability insurance. Under employer liability insurance, the insurance that the employers obtain for employees who work under them to pay compensation for wounds and the things that they have, they are facing. Right now, if something has happened to the employee in the organization, right? So if you have got the employer liability insurance coverage, so that you can pay them and you can, that you will be covered, right? So what is it? So it is the responsibility of the employer to pay compensation for the accidents to employees. It's your responsibility now. So your employees are under you, right? So then you need to pay them if something has happened, right? So that because they are working for you now, right? So in that kind of situation, the liability to pay compensation can be transferred to an insurance institute. So now suppose that something has happened to your one of your employees, so you can pay them and you can get the money back from the institute, saying that you have paid this person for this reason, right? That is under employer liability insurance, right? Now there are liability insurance policies: general liability insurance, product liability insurance, employer liability insurance. Then there is another insurance the policy that we discussed: goods in transit. What do you mean by goods in transit? That means when you're sending goods or when you're receiving goods. Okay, so in the meanwhile, if something has happened, if you have got the coverage from goods in transit insurance, that you will be protected, right? So insurance that is obtained to cover the losses that can occur to goods from the moment they are loaded to transport till they are unloaded, right? So that's the period, children. Moment they are loaded until they are unloaded, right? So that's a period that you are responsible. Okay, so that is known as goods in transit insurance. Then money in transit insurance is also the same. So what is money in transit insurance? So the same way, like the goods, the money, right? The insurance that is obtained to cover the loss that can happen while taking money from one place to another is known as money in transit insurance, right? So those are the insurance policies that we discussed under. Yeah. Wait, I'll show you that. It. General insurance. Now here, under general insurance, fire insurance, now we discussed theft and burglary insurance, natural disaster insurance, marine insurance, motor vehicle insurance, liability insurance, goods in transit, and money in transit. So now if they ask you to name some general insurance, you can name from them, right? These are the types of general insurance that we have discussed, right? So everything that we have discussed here now. All right, children, so that's the end of the lesson for today. So then next week, I'm hoping to do transportation and communication as well. But transportation and communication are 2 units. But I thought that I can cover from one session both the units. So hope you will join, right? So I'm hoping to cover both the units next week, transportation and communication, so that we have only one lesson more to cover grade 12 syllabus. So after that, we can move on to grade 13. So hope that you have understood, right? If there's anything that you can just send me questions so that from my next session that I can answer those things. All right, children. So thank you for joining. So I'll end the session for today.
Thank you so much, madam, for joining with us today. And also, we will meet from another session. And children, don't forget to subscribe on Nanapura YouTube channel. And again, thank you, Madam Sanjeevani, for joining with us today. And have a nice day. Goodbye.
Bye.
වාණිජ විද්‍යා ගණිත කලා තාක්ෂණ වේදය විෂය ධාරාවන් වල සියලුම විෂයන් සඳහා විශ්වවිද්‍යාල කතිකාචාර්යවරුන් සහ රජයේ පාසල්වල ප්‍රවීණ ආචාර්ය මණ්ඩලය විසින් මෙහෙයවනු ලබන දේශන නැනපවුර YouTube channel ඔස්සේ නැරඹිය හැක. ඉදිරි දේශන දැනගැනීම සඳහා නැනපවුර YouTube channel subscribe කරන්න. දැයි දූ දරුවන්ගේ අනාගත ජයග්‍රහණයට